Sell all your stocks, liquidate your portfolio, go to cash and wait for the crash. That is the feeling for a lot of people right now with the markets hitting all-time highs recently, particularly the S&P and NASDAQ. And it's the subject of today's video. I'm going to get into 3 reasons people tend to quote most about why it's time to sell all your stocks and go to cash. And I'm also going to counter those with Goldman Sachs article that they produced in January of this year in 2025, where they presented some data on those 3 main reasons why people should liquidate. So that's the subject of today's video. Let's get right into it. All right, so with markets having hit all-time highs through most of July and now starting to wobble in August, people are getting a little bit anxious and nervous and thinking it maybe is a good time to sell. And I certainly understand the sentiment. I feel it at times as well. But can you time the market effectively? The real answer is you cannot. I've been at this for 20 years. Loads of clients' accounts and data I have seen, and nobody can really do it properly. In fact, Terry Smith, one of the well-known fund managers here in the UK, who had some really great success with his Fund Smith equity fund, particularly when it first launched in 2010, he summed it up best, where he said, when it comes to market timing, there are 2 types of people. Those who can't time the market and those who don't know that they can't time the market. And I couldn't agree with him more. But you hear it all the time at the moment, and there's really 3 things, like I say, that people like to quote. One is that they believe that equity earnings and valuations need to revert to the mean. The market is just too overvalued, so therefore it's time to sell your stocks. The other, of course, is equity valuations overall on a PE ratio basis, which is really just price to earnings, a gauge of how expensive a company is trading at right now, is just too high, unsustainable, and it's going to have to sell off on the back of it. And the third reason that people quote all the time, you hear this in the media a lot, and that is the concentration risk of the Mag 7 or the top 5 stocks in the US being such a high percent of the overall S&P 500, and this is a signal that it's time to sell and go to cash. So I've dug out this report. We're going to get into it and address those 3 because they presented some good data on it, and hopefully it helps you. If you're having this sentiment yourself about maybe selling, hopefully this helps you give something else to think about, at least another point of view, so you can make the right decision that's best for you. All right, so on my screen here, you see this report. So let me just go up to the page that I'm going to focus on. I mean, this report has over 100 pages in it, 118 to be a bit more accurate on that. But I wanted to get into this section specifically because it addresses this. And I've thought this myself. Should I stay invested in US equities? As you know, a lot of people would know I do the S&P 500 mainly, not always, but or should I get into bonds or cash more now? And that is the subject of this little section of this huge report right here. Okay, so we're not going to go through it line by line, but we're going to tackle sort of the main points here. Okay, and really Goldman Sachs in this piece is arguing that it's not time to sell off and get into cash or bonds. And here's the reason why. The premise for our recommendation to stay invested is threefold, and these are the 3 reasons. 1, there's no evidence of mean reversion in equity valuations. Valuations do not have to revert to any long-term mean over any specific horizon. Number 2, valuations alone are not a good signal for exiting the market. I think that's important because everybody's thinking valuations are so high, it's time to get out. Market concentration. Now, this is the amount that the top 5 stocks, the percentage they are on a market cap basis of the actual S&P 500. We know it's at or around all-time highs right now, and market concentration is not a good signal for exiting the market, according to Goldman Sachs here on this data. So let's get into it a bit more on the mean reversion. So there's one point here that I really want to highlight. So since the time in 2013 where they first came out talking about this on the mean reversion, and this is on valuations and earnings, the S&P 500 has returned 416% or 14.6% annualized, and this was in 2013. Okay, so the market has even gone up so much more since they first put this on the table about mean reversion, and in that they showed loads of evidence basically that that there is no evidence that equity valuations always revert to the mean. Okay, The evidence over the last 12 years reaffirms the absence of mean reversion. And so what do we have on the screen here on Exhibit 52? What we have is the Shiller-Cape ratio, which is basically the cyclically adjusted PE ratio. And that tends to be used mainly for valuations on the stock market at any given time. And as you can see, there's some pretty big spikes here. In the 1920s, the roaring 20s, as they said, the dot-com boom, and then you have the bust after that, and then here we are up here at 37.7 on the Shiller-Cape, which is still pretty high, as you can see there. But if you look at the table below here, or the graph below here, and what they're basically saying here is you're just looking for these spikes above the 95% threshold, and it's barely happened. So in other words, equity valuations reverting to the mean does not happen that much at all, okay? So it's a common myth that it has to happen, and according to Goldman Sachs in this data, it happens very rarely. So if you look at this little section here, mean reversion has been statistically significant just 1% of the time since 1930, based on a 50-year rolling window, and 2% of the time using a 20-year rolling window. So that does not really indicate a mean reversion, okay? All right, so the number two myth, or the number two reason that people think right now could be a good time to sell their portfolios and go to cash, is all around valuations. And according to this article here, Goldman Sachs would say that valuations are not an indication of when to sell and exit the market, okay? And in fact, they lay it out very clearly. History also shows that valuations alone are not a good signal for exiting the market, okay? Since US equities first entered the 9th decile valuations in November 2013, the S&P 500 has rallied about 300%. And since they entered the 10th decile valuations, equities have returned over 200%. And basically what they're saying here is, at a time where S&P 500 valuations is more expensive than 90% of other times that were measured, it hasn't given it a reason at that point to sell off and exit the market, I should say. And I think if you look at Exhibit 54, it shows this in good detail. So if you look here, December 2016 in particular, you can see that stocks on the S&P 500 entered the 10th decile of valuation, meaning they were more expensive than 90% of the other times that the market was being measured in this case going back to 1990. And look what the market did since then. It actually went up 202%. So had you exited at that point based on valuation, and I can tell you anecdotally in my 20 years in the markets, I've heard more often than not that the markets are overvalued and due for a sell-off or a crash. But had you followed that, then at that point, when the equities had entered the 10th decile, then you would have missed out on a 202% return going back to only December 2016, which is not that long ago. So therefore, we can conclude that it's really not a good indicator here when it comes to valuations. And that's what people are talking about right now. Valuations are driving a lot of this rationale to liquidate your portfolio. All right, the third one is market concentration. So history also shows us that a high level of concentration of the top stocks in the S&P 500 is not a good signal for exiting the market. Okay, so if we scroll down a bit and we look, the top 5 stocks in the S&P 500 account for 29% of the index's market cap at the time of this report at the beginning of the year, January 2025. The highest level since 1980, which we can see in Exhibit 57. Here you go, up to 29%. That is massive. And if you look at a chart, it's scary, frankly. Okay, but then they go on to say that that's really not anything to worry about, because the data shows, as can be seen in Exhibit 58, the level of concentration has no bearing on returns over the next 12 months. The R squared, which explains the variance in equity returns that can be attributed to level of concentration, is negligible at 0.04%. So basically, what they're saying here is that the market concentration has got a very extremely low indication that it's time to sell and exit the S&P. It has no bearing over returns over the following 12 months. Okay, they even say the results are the same if they use alternative measures and use the top 10 stocks, for example. And then this paragraph, I think, sums it up quite well. If you're wondering whether to sell your stocks because of market concentration, then even going back to the Great Depression, market concentration has not been an effective timing signal for exiting the equity market. S&P 500 returns 1 year after peak levels of concentration have been attractive in 3 of the 6 periods, with the 3 losses resulting from recessions. Returns 10 years after peak levels of concentration have been attractive in 5 of 6. The one exception occurred after the bursting of the dot-com bubble. So the truth is over the next 12 months, nobody really knows where the markets are going to be. And it's about a 50-50 chance they'll be up or down from right now, according to this data. And that includes right now when you've got such a high market concentration. But if you go 10 years out, the numbers change entirely. And of course, the results are more positive for the stock market 10 years from now, being up, of course. And that's how you need to think of it when it comes to stock investing. 5 or most typically 10 years out from right now. And even with this high level of concentration, 10 years from now, the market is almost certainly going to be up and higher from where it is. Okay, so that should tell you right there that it's nothing to worry about. Okay, so there you have it. We've gotten into this Goldman Sachs report where they talk about the 3 reasons that people tend to want to exit US equities. And I've heard these for 20 years now. And that's valuations always revert to the mean. The valuations are so high, it's time to get out of the market. And the stock index is so concentrated that it's definitely a sell signal. They've been able to present data that shows the contrary to all of those. So basically, if you're sat there wondering if it's time to sell, then this is something you should consider ultimately for your portfolio and your decision making. Deciding to sell your portfolio and go to cash is a massive, massive decision to make. And if you get it wrong, it can have catastrophic results. It solves one problem, a little bit of anxiety you may have in the market selling off, but it creates another. When do you get that money back in? And I can assure you, most people, if not all, have failed to get the money back into the market at the right time, and they end up missing the recovery. So just keep all of that in mind if you get a little bit anxious on valuations and where the stock market is at the moment with everything that's going on. Well, that's my video on whether or not you should be liquidating all of your portfolio and going to cash to avoid a crash. I hope you found it useful. If you did, click on the like button. Subscribe to my channel if you haven't done so already. Leave me a comment and tell me what you think of this video and the data that Goldman Sachs has put out there for us to read. I'll put a link in the description to it as well, so you can download the report and read it all if you want to. And if you want to know how I would invest £10,000 into the stock market right now, even with the market at all-time highs, no problem. I did a video on that recently. I'll put a link to that one up there, so just click on that. I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.